Ladies and gentlemen, I've been asked to speak about the latest trends in gold, which I suppose for many of you would think is really relevant, but I think it is very relevant. The latest trends are the culmination of 160 years of monetary meddling by governments, taking us from gold and silver being the only money chosen by society itself, to a world of fiat currency, and the economic and political establishment has persuaded us that gold and silver are no longer money, just commodities. But this new century has seen the growth of a new middle class at the heart of 4 billion Asians who only know gold and silver as a reliable store of wealth. Inevitably, this is now disrupting Western governments' attempts to suppress gold and the gold price. And to make sense of it, I'll break the subject down into 4 parts. I'll start with the relationship between gold and government-issued currency, then the current monetary situation, and I'll follow that with the Asian dimension, and finally, the events that took place last year, which are relevant to the latest trends in gold. Throughout history, governments have cheated their citizens by foisting government currency upon them. But the greatest swindle of all is our current Keynesian-inspired corruption of money. Like all currency swindles, today started out as gold substitutes. Printing currency without being backed by gold is actually a fraud against savers. But our monetary corruption includes official sanction of a second fraud, the expansion of bank credit out of thin air. And I say fraud because if any of us did it, we would go to jail. A bank is permitted to breach this natural law because it has a government license to do so. It all started with the Bank Charter Act of 1844 in this country. This gave the Bank of England the monopoly to issue banknotes, which were freely convertible into gold at the time. But most importantly, there was no restriction placed on the creation of bank credit. The result was a series of credit-driven booms and busts in the second half of the 19th century. These included a new role for the central bank, and that was acting as lender of last resort. Due to Britain's global dominance, the gold-backed pound was accepted worldwide, and the Bank of England was also the model for all other central banks. So we owe the whole central bank concept to the Bank Charter Act of 1844. And with that concept comes bank credit, that is to say, the creation of money in the form of bank loans out of thin air. America set up her central bank, the Federal Reserve Board, or the Fed as we call it, in 1913. It created a monopoly dominated by the large banks, and it was designed specifically to allow the expansion of money and credit without member banks facing bank runs. The corruption of money can be clearly seen in this chart, which encapsulates both cash and bank lending. The PEX line shows the average rate of increase of this measure of money supply up until the Lehman crisis in 2008, before which it grew at an approximate compound rate of 5.8%. The long-run growth of the quantity of gold in the world is far less, and this is shown by the gold-coloured line on the chart, just down towards the bottom there, and that's derived from annual estimates of the above-ground stocks of gold. And this chart therefore sums up the difference between sound and unsound money. On the asset side of the bank's balance sheets, financed by deposits, is loans or credit. Bank credit, together with bond investment, has supported far larger quantities of government and private sector debt. These are currently estimated at about 50 trillion for government debt and 200 trillion for private sector debt. These are huge numbers, but for historic debt only. We should add in the net present value of far larger future government welfare obligations. Estimates for the US alone add an extra 220 trillion. And they are the good guys. Japan, Scandinavia, the Eurozone and UK have far higher welfare commitments. Every time a credit-driven crisis occurs, the answer is to put it off with more debt. The money moves on, but the debt remains. Most of this debt will never be repaid. It needs more and more currency to support it instead. And this brings us to the current monetary situation. In September 2008, Lehman went bust. Lehman was counterparty to trillions in derivative contracts and collateralized loans. It was clear this bankruptcy would collapse the other American banks, and with them the entire global banking system. The Fed opted to underwrite the US banking system by making available infinite quantities of money and credit. The world was saved for the umpteenth time by a central bank from the consequences of its own monetary mistakes. And the Fed continued to print money with QEs 1, 2 and 3. It did this initially because it believed that monetary stimulus would lead to economic recovery. It was and is also cover for continued support of the banks because they still have hidden losses on their balance sheets. The stock market is supported by zero interest rates to maintain the illusion of wealth. And the government also needs the money to pay for annual deficits. The Fed's cure-all of monetary expansion is shown in this chart here. The monetary base expanded 3.5 times between mid-2008 and today. This expansion is unprecedented and is fueling the asset bubbles in all markets worldwide today. This expansion is also reflected in the previous chart of US dollar FMQ, or fiat money quantity, which has literally gone hyperbolic. It's time for me to explain the thinking behind the fiat money quantity. I constructed FMQ to give a comparison between currency and gold, unsound and sound money, if you like. The idea was to retrace the steps whereby our money, our gold, ended up in the hands of the central banks. A few hundred years ago, our ancestors deposited their gold in banks and were given tradable receipts to use as money, and ledger entries showed their gold deposits. So the first step in estimating the difference between sound money and fiat currency is to quantify both notes in circulation and accessible deposits. When the note issuing facility was surrendered to the central banks, all gold held by individual banks was passed on to the central bank. So we need to include the money and deposits our banks hold at the central bank as well. That in a nutshell is FMQ. So FMQ in this chart is a measure of the fiat currency in the entire US banking system. This next slide shows how the relationship between money and gold has changed between the 30s depression and today. The concept of the inverted monetary pyramid was the brainchild of John Exter, who knew more about gold and money than any other American banker of his generation. The gold shown is the dollar value of official reserves, and the monetary base is what we saw 2 slides back. In 1932, which is the pyramid on the left, the monetary base was 1.7 times gold reserves. Today, the second pyramid, the one on the right, the Fed ignores monetary discipline, and the monetary base stands at 11 times the value of the US's gold reserves. Worse still, there is growing evidence that these gold reserves are considerably less than officially stated, and some would say that they've got no gold at all. So the relationship between US gold reserves, assuming they exist, and the monetary base today is the same as between US gold reserves and the sum of money and bank credit in 1932 at 11 times. The relationship with the fiat money quantity today is now a staggering 36 times geared. But it doesn't stop there, because the entire world currency system is based on the dollar as a reserve currency, and we must assess that relationship as well. Now let's relate the broader picture to the US monetary base. The last slide was about relating it back to gold, which is either there or not. We're now talking about relating it to the US monetary base. Since the Fed rescued the world in 2008 from its own monetary follies, it's expanded its monetary base by 3.5 times, as I said before. Add in US bank deposits, and gearing rises to 14 times the pre-Lehman monetary base. The estimate of foreign currency cash and deposits converted into US dollars gives us a further expansion, taking it up to 91 times. And lastly, we must include off-balance sheet lending, which in 2011 was officially estimated to be about 65 trillion worldwide, but given rapid expansion in China, I think it's probably closer to 75 trillion today. This added up gives us over 155 trillion. And that takes our global gearing up to nearly 180 times. That, ladies and gentlemen, is the ultimate bubble. And that, ladies and gentlemen, is the bubble everyone misses, fiat money itself. It is going to burst. And when it does, the only money that will survive, if history is any guide, will be gold and silver. So that's the background to the gold price. We enter the last act of our monetary crisis with gold badly mispriced. Monetary inflation has puffed up all asset classes, bonds, equities, property, fine art. But the gold price has been suppressed as part of a long-standing campaign to ensure it is no longer regarded by us as money. By the end of last year, adjusted for both the increase in FMQ and the increase in above-ground gold stocks, gold was priced at only 62% of its pre-Lehman level. Yet the risk of a financial crisis from a monetary collapse has increased substantially. Ever since President Nixon ended the Bretton Woods Agreement in 1971, the Fed has maintained that gold is no longer money. In conjunction with the other major central banks, the primary objective has been to stop us thinking of gold as money. Our central banks manage the price by leasing it to bullion banks, who sell it in the market. At times of financial stress, they accelerate these sales, and last year they started aggressively intervening in futures markets. This is why the gold price is where it is today. 62% of its pre-Lehman level in real terms. It is also, incidentally, at 40% of its 1934 level of $35 in real terms. In other words, it's cheaper today than when money was sound, or currency was relatively sound. I firmly believe that growing intervention in the futures market is evidence that finally Western central banks are running low on physical supplies. Now this is a very important development. And that takes us to the Asian dimension. So let's now look at where all the world's physical gold is going and why. 4 billion Asians regard gold as their safest asset. An Indian would have bought gold at 170 rupees an ounce in 1965. He would have continued to put his savings into gold over the years. Today the street price in Mumbai is 100,000 rupees, up nearly 600 times. The Turks had 6 noughts knocked off the lira in 2004. So it's hardly surprising that Turkey's people are long-standing buyers of gold. The same love of gold and distrust of government currency is in the psyche of all Asians. More recently, China has embarked on a deliberate policy of cornering the gold market. I believe they are doing this partly for geopolitical reasons, and I think it's a racing certainty that they know what's in the West central bank's halls. Not only am I convinced the Chinese government acquires all its own mine output, but it is probably actively buying for itself in Western markets as well. Furthermore, China has a policy of encouraging her own citizens to buy gold. It allows China to reduce her trade surplus. This places China in a position of enormous power, and there is no doubt she has achieved this coup by getting Western central banks to give up their monetary gold in their fruitless attempt to suppress the price. Now, most of you, I'm sure, are aware that Chinese demand for physical gold is now overtaking India's. But the true figures have actually been concealed from you. This next slide summarizes the combined demand of China and India. Thank you. The upper half of the table contains my figures taken from official sources, while the lower half is the World Gold Council's estimates. The results are very different. On my figures, total demand in China and India leaves a global deficiency over the last 3 years of 2,407 tons relative to global mine supply. The World Gold Council figures instead show a surplus of 3,357 tons. So how does such a large difference of 5,760 odd tons arise? The World Gold Council method attempts to identify demand at the retail level by gathering statistics from the jewellery trade and also from industrial users, and to somehow estimate industrial demand. In contrast, the Chinese government actually tell us what public demand is. It is simply gold delivered to the public through the monopoly physical market, which is the Shanghai Gold Exchange. Also, Hong Kong gives us accurate import, export and re-export figures. So we know how much is turned, for example, into jewellery and sent to China, which is not clear through the Shanghai Gold Exchange, and how much is sold locally to Chinese visitors from the mainland who buy their gold in Hong Kong to avoid sales taxes. Lastly, China is the largest gold miner in the world, and we know from global refiners who take in bars from everywhere that none of this gold gets on the open market. Also, it is unlikely that the Chinese government plays by the rules and buys domestically mined gold through the market. So on that basis, I believe we should add in mine production as well. The only factor I've not allowed for in my estimates, for simplicity really, is scrap recycling. In 2011, it would have been a significant figure in China, perhaps several hundred tons, as some bullion withdrawn from the SGE vaults was cashed in profitably. Since then, there is unlikely to have been as much scrap because of lower prices. Against that, there's good reason to believe the Chinese government buys gold for itself in London and elsewhere, which is not put through the SGE. And it is also likely that the ultra-rich Chinese buy gold and store it outside China. This again is not recorded. In contrast, the World Gold Council not only misses the majority of public gold demand, but it assumes China's production satisfies part of it, and so is not additional. It has also come up with world gold mine production figures which are significantly higher than those put out by other sources, such as the US Geological Survey. Unfortunately, their figures are the ones accepted by the media and by brokers' analysts. They are very misleading. And the result is that nearly everyone in the gold market is asleep when it comes to understanding the true scale of Chinese demand. The only way this demand can have been met is through central bank sales. ETF liquidation, which is the usual explanation, is simply not enough. The other 1.5 billion people in Asia are similarly savers in gold. Countries like Turkey, Iran, Thailand, Indonesia, Taiwan, Vietnam, as well as, of course, as the Arab world. The central banks must have been the principal source of gold in their attempt to manage the price. There is nowhere else this could have come from. So this takes us up finally to last year's events. These are some of the events that showed the strain on the markets last year. Starting with the German gold, how is it that the New York Fed can only find 5 tons out of the 1,536 tons they hold of Germany's gold to return to Frankfurt? I mean, it just defies belief. And this is taken by many of us as evidence that the gold isn't there, or it's gone. The Cyprus bailing was a big, big event, and it alerted everyone in the Eurozone that their deposits weren't safe. And the signs are that a run then started on bullion deposits with the European banks, with customers looking to take their gold into their own custody. Now this was a problem which had to be diffused, which is why a decision was taken at the highest levels to persuade investors that the gold price was actually in a bear market and would go down. Well, they managed that all right, but the unintended consequence was record demand for physical bullion at what were, and still are, artificially low prices. And I think anyone who has a slightest inkling of price theory would understand that that was the natural result. Not central bankers, apparently. The extent of this demand was concealed from us by the World Gold Council and others, as I've just outlined. But I was able to expose the disappearance of up to 1,300 tons of gold from the Bank of England's vaults. This explained where all the gold was coming from, and explains why Britain was the largest exporter of gold in the world last year, according to Eurostat figures. So far as I'm aware, we've got one gold mine called Clogau in Wales, and it doesn't produce anything like that. The appointment of the head of the Indian Reserve Bank was also suspicious. And it looked like a put-up job by, if you like, the central banking cabal, I would call them that, and designed to rein in Indian demand for gold. And Mr. Rajan, who was ex-IMF, obliged by introducing strict import controls. It was him who did it. And then the last thing, the important part of Finland's statement, was that they more or less said that feeding monetary gold into the market is normal for all central banks. So last year we had so many instances that show that this game is actually very mature and coming to an end. And basically, the gold is gone. So, in conclusion, so sooner rather than later, the global currency bubble will explode. My bet is we're not all that far from this happening. Just bear in mind that 180 times geared on the US monetary base pre-Lehman. Gold and also silver are underpriced in the market even without this event. We have been cleaned out of our monetary gold. It has been sold into the market and bought up by nearly 4 billion Asians, never to return. Portfolios in London and New York and even Zurich are woefully underinvested in gold and silver. By suppressing the price of gold, the West central banks have stored up trouble for us all. If the currency bubble does burst, gold will multiply in price, and Western central banks will be unable to stop it. We will be witness to the biggest wealth transfer in history. If you think I'm right, just make sure you're not among the victims. Thank you.